So, what is the difference between term life insurance and whole life insurance? Most of us have heard of this terminology, term versus whole life, but it can be a little confusing to differentiate them. So, we'll go through a couple examples and explain each. So, in terms of the concept of life insurance, the idea is you insure your car, you insure your health, you insure your home, and all it is a hedge against risk. In your auto insurance, you're having a hedge against the risk of getting in an accident. In the health insurance world, of course, it's something that's going to happen to your body. Well, in the life insurance world, your life and your contribution to the economy and your family has a present value. And therefore, you can insure that because you are an asset to your family and to the economy because you contribute. And therefore, your life can be insured to make sure we're hedging against you not being there or you passing away. And so that's the concept of life insurance. Now, the two types, term and whole life, are just how, one, you pay into this policy, and secondly, how the coverage is broken up and what your real goals are with it. So the analogy I like to use is thinking of the term versus whole life in the real estate world, right? So term insurance is like renting, right? So if you go and rent a property, it's typically on a set lease. It might be 1 year, 5 years, 10 years. And that's what term means. It means the term or the length of time that you set up. And so all that really dictates is you're going to pay this premium or this expense every month. And that's going to give you a set amount of coverage for a set amount of time. That's all term insurance is. The challenge with term, which most people don't understand, is that there's no built-in equity of any kind. So just like renting, when you pay your landlord $1,000 a month or $2,000 a month in rent or whatever it is, it goes and it kind of evaporates. It's just an expense. It doesn't go into paying down a loan, which then builds your equity. It is simply just an expense, and it buys you the coverage, and it's sort of just the fear of if something happens to you, term is in place to give you that payout. Now, in terms of what the structure is, when you pay into term, those are usually much cheaper programs. You can get term insurance for as low as like $20 a month. And most people have very, very small policies. So if you're paying a small amount in premiums, you're going to get a small amount of coverage, or basically death benefit. And the death benefit is simply the amount of money, the lump sum that's going to be paid out to your beneficiaries when you die. And so that could be if you die in terms of term, right? So if you do like 20-year term and you're paying a small amount per month, it might only get you $30,000, $50,000 worth of coverage. So if you were to pass away prematurely or unexpected, your spouse, your business partner, your children, whoever you deem as the beneficiary would get a lump sum payout of that death benefit, tax-free to them, based on what you paid in. So the death benefit ratio bases off of how much you pay, and that's how the coverage works. And at the end of the term, if there's no rollover, that's pretty much it. You can get creative and add some things on there, but basically it is just a hedge against if you were to pass away. So that's the term side. Think of it like renting. The whole life side is, as it sounds, for your entire life or your whole life. And so the reason that this is different is because it's more like owning a home, in that you're going to pay that same premium like you would in term, but it's actually going to go into a couple different places. So you're going to have the one component that's going to go into paying the expense of the insurance. Think about in the beginning, when you have a mortgage, all of your expense that you pay in, the majority of that goes to interest and paying the bank or the lending source. The other portion of that is actually going into equity. So as you pay down that balance on the mortgage, you're actually increasing your equity in your home. Same idea in a whole life policy. So as you pay money in, yes, you're going to be covering that expense, but you're also going to see some accumulation of real cash inside these policies. And so, not to get in the weeds in this video here, but there are all kinds of ways to structure your policies that you can increase that cash value, make the expense as small as possible, so that you can actually grow and build equity, right? So if you're paying in your mortgage, you want to pay as high as possible into the equity portion and get the expense knocked down as low as possible, so you're not eating into that over the long term. So whole life is just a structure that is in place for the length of time. That doesn't mean you have to pay into it for your entire life. There's all kinds of what are called riders and exclusions, basically options and ways that we can structure a policy or a contract for your unique needs. So everybody comes in with different amounts of money, income sources, ages, and goals when it comes to life insurance. And so Whole life can be used more as a flexible savings asset, and we can put all kinds of creative exclusions and riders in place to make sure we're optimizing this as a real sort of financing tool. And this is how the ultra wealthy are really utilizing these things. And so that's what product we use when we set up our leverage wealth accounts. And if you look over historically what big banks, corporations, and ultra wealthy people are doing, they're using a whole life to achieve those goals. It's just very strategic in how they do it. So that's the difference between the term side, like renting a house, you get just basic coverage, it gives you a roof over your head, that analogy, or you get the whole life, which is more of like purchasing a property where you're building in equity. It's a longer period of time and it's used in a different way.